Hi, I'm Greg Hunter, and we're talking with Charles Biderman. He is the CEO of Trim Tabs. It's a venerable Wall Street research firm. And I have to add to your intro, Mr. Biderman, you have been right a lot. Thanks for being with me today.
Well, thanks for having me.
Well, the big underreported story, I think, is the European sovereignty crisis, debt crisis, banking crisis, whatever you want to call it. But it's a huge problem. Spain is in the news. They're protesting. Unemployment's 25%. We've got a mess over there, do we not?
And it's getting worse and going to continue to get worse, dramatically so over the near term.
Well, what happens if they can no longer, finance their countries at a cheap rate? The bond rates in Spain are now 6%. Eight countries are officially in recession. I think it's more than that. What happens to the EU?
Well, it's going to dissolve. It's going to go back to the EU might be several countries, but it will not be 17. Certainly the periphery will disappear, and those countries will have to restructure. I mean, not only restructure, meaning devalue their currency so they can wipe out their debts, but restructure how they run their countries. They're going to need to have economic growth as a possibility and not social welfare as the main concern for the economies. But in the meantime, I don't see any way that the euro can be saved. It might take a couple of years, but I just don't see it happening.
So, you don't see how they can save the European Union. But doesn't this problem, and will this problem also affect the U.S.? And if so, how?
Well, the U.S. is in a similar shape, not as bad. There's still growth here. There's no growth in Europe. Everything is contracting. We're growing modestly, about 1% faster than inflation, based upon the real-time data we look at. So we're in a little better shape. But ultimately, we're currently spending $300 billion every month, the U.S. government. It collects $200 billion. And it prints and borrows $100 billion every month. Now, there's no way the $200 billion it currently collects will grow to equal $300 billion a month in taxable income anytime soon. And given the entitlement costs for an aging population, of which I am now officially eligible to retire, and a lot more like me, the amount of money spent on pensions and Medicare and Medicaid and Social Security, we just can't afford it. And there's just no way it's going to happen. So we're also in a delusional world in reality. But for right now, if we print money, maybe people will accept it, and we'll kick the can down the road a bit further, and maybe the next administration will have to worry about it, not this one.
Well, I was watching CNBC, and, this week they had on a couple of Fed presidents, and they were talking about, just like Ben Bernanke, the tools are on the table, and they're talking about more accommodation, and they can still expand their balance sheet. And, well, if the economy is in recovery, why do they have to expand their balance sheet? Why do the Fed governors, including Ben Bernanke, have to talk about, monetizing debt and continuing with QE3, I guess that's Operation Twist, and QE4. I mean, you're saying we are in fact in QE4 right now.
Well, we're ending QE3. Operation Twist is QE3. It's $500 billion. QE1 was $800 billion. QE2 was $600 billion. QE3 was $500 billion. We peaked out. The stock market peaked out early May last year. At about 19 trillion in overall market cap, which is pretty much where it is today. 19 trillion overall market cap. And that a year ago was 2 months before the end of QE2, and now we're 2 months before the end of Operation Twist. And real-time data, based upon income tax collection, stuff we look at, indicates that the U.S. economy has not been growing faster than 1% after inflation in terms of after-tax income for everybody who pays taxes. For the last 6-7 months, it's been pretty much stagnant. So in essence, we're printing billions and billions of new money. And out of that billions and billions of new money thrown into the economy, we're getting growth barely above inflation. So that says what happens if you stop printing those billions of new money, growth will slow down altogether. And we have these obligations based upon ever increasing income from a growing economy to meet these future obligations. But where is it going to come from? Where's the, it's like we're delusional as well. Our problems are a little further down the road than the European ones, but it's the same road.
But if Europe blows up, won't that crater some big U.S. banks that have exposure?
Sure. What's wrong with that? Most of the big banks, it's not they're too big to fail. They're too dumb to be successful as a big bank. People who run banks are not the smartest guys on the planet. Dumb guys running a big bank is dangerous. These guys should be allowed to fail regularly. Let's clear out the deadwood. I mean, these guys, they're dangerous. Look at what they've done to us so far. And,
yes, and then we've spent trillions of dollars trying to keep them afloat. No,
but here's the real problem. The real problem is bankers are about as dumb as politicians. So, and they congregate together. So every time, if you look around the globe, who's been saved by all the bailouts? Only one group in common has been, and that's the banks. The politicians and the bankers all take care of each other. I'm not a conspiracy, and it's just, but they're stupid enough, and smart enough, and basically stupid enough to just hang together and die together.
Why aren't we seeing? I mean, we're going to continue to print money, correct? The U.S.
Until the world says, "Hey, I don't want this funny money anymore."
Why aren't we seeing more inflation? And if we are going to see inflation, when's the big inflation? When do the big fireworks hit?
Inflation. We are seeing it's now 3% or so. If you look at real time, there's numbers. I've seen 5-6% inflation. If you back out stuff that the government controls and just what people are, market force items. It's inflation is building. I mean, it's. I don't want to own the U.S. currency.
What would you do as a small-time investor? How do people protect themselves?
Well, I'm going to start a market letter soon, Biderman's Market Picks, and I'm going to talk about my portfolio, which is pretty much a third gold and silver, a third inflation-protected securities, some growth stocks like Apple and Salesforce.com, and my Trim Tabs Float Shrink ETF, which is an ETF. I'm the portfolio man, invests in 100 companies that are shrinking the trading float the most, only using free cash flow to shrink the float, and they're not borrowing to buy. And so historically, we've done very well. It's performed in the last 6 months about 28%, and the market was about 25% up. So it's doing very well. And I'm also recommending shorting Europe and shorting the euro and shorting the emerging markets.
Shorting the emerging markets.
Well, I really think that the markets are vulnerable and are going to go down over the near term. Maybe not this week, but when the paddy wagon comes, it takes all the girls, good, bad, and indifferent.
Well, let me talk about back to Europe just a bit, and I think this is underreported. Does that mean that people like me who find this pretty dire over in Europe, that we're overreacting, or is the financial press here underreacting?
Well, the real problem is that you cannot get hard real-time data on what's going on in terms of cash flow for countries, debt service. They control their outlet. But if you look behind the line, this is how much money is being raised. This is an aggregate. You just see that they're continuing to borrow more and more money than they ever hope of making on a regular basis, and at some point, it'll implode. And they don't understand that to generate more income, you need to grow the economy. You don't raise taxes and make it harder for people to do business and expect the economy to grow to pay the expenses. No, you cut spending or you cap spending and you free the economy. Go make money.
There's been a couple of people. There's been a couple of people that think that Europe will implode this year, and some other people think that it probably will implode next year. What's your prediction for Europe? They're not going to. Number one, they're not going to stop printing money. I don't think they're going to put in these market reforms you're talking about. They're pretty much going on this path. It looks like they're going to implode. What's your timing for that?
This later this year, early. It's one of these. This is a black swan phenomenon. It's going to go on the way it is with people like you and me saying this is impossible until the day it becomes possible and happens, and everybody says it's obvious, and it implodes. And let's figure out how to solve the new Marshall Plan or something like that. Or let Germany run the show. Let Germany pay everybody's bills, and Germany can take over Europe, which is what it's been planning to do anyway.
Yeah, they'll do it without a barrel of a gun. They'll do it financially.
Yeah, right. I mean, and then they and the Russians can fight each other. Which I wouldn't be unhappy about, and the Chinese too. Let the three of them fight.
So you think that Europe will probably implode this year or next year?
Probably, I'd say 75-80%.
And what do you think that effect is on the U.S.? Do we implode too? Would that crater be big enough to suck us under?
Well, I did one of my videos analyzed long-term trends in the market. So, during the years that the bull markets all coincided with rapid economic growth, surprise, of like 5% or so in terms of incomes, which we track. I don't track GDP. Government data is a waste of time. That's another story. At time, like from 83 to 2007, was the age of first the personal computer, then the internet, and then broadband. That 25 years marked this total wealth in the stock market. The value of all stocks was $1 trillion at the end of 1982. It peaked out at $22 trillion in 07. That's a 22 bagger in terms of wealth. So at the same time, and the average PE when the economy growth was 20. Then during bear market cycles, you go back in time, economic growth is below 3%, like 3%, which is where we are now. We're at 1%. And during those times, the average PE is under 10. And if it were at 8, that means the S&P should be, cut in half or more.
So you're thinking the stock market is way overvalued?
Well, it's pumped up by printed money. But, the Fed created, $1.9 trillion by, quantitative easing 1, 2, and 3 already. And how much of that ended up in the market? I mean, that was printed money. It was used to buy assets. People who had those assets, some of it must have gone into stocks.
So you think when the money printing stops, the stock market gets cut in half?
Yeah. Or when people stop willing to believe that the money printing is good.
Well, one last prediction here. What do you think gold and silver will be at the end of this year, 2012?
Higher.
Higher. Much higher. Is that the same theme? Go ahead.
I recommend dollar cost averaging gold and silver and inflation protected securities and trim tab slow shrink ETF each month. Okay,
and is this the trend to buy physical assets? Is that something that you see? I mean, you hear stories of, the billionaires are buying artwork and they're buying diamonds. Of course, they're buying gold or they're buying silver. They're buying farmland. Is this a trend that you're seeing?
Well, I think within a few years, we're also going to see a new reserve currency probably dominated by China. Their currency, or maybe a combination of the BRICS, or hopefully not the Russians. Maybe India, China, and Brazil create a reserve currency, and that's where people will go.
All right, Charles Biderman, thank you for being on with USAWatchdog.com. Really appreciate it.
You're welcome.
Okay.